Hi everyone, my name is Busadi Abiodun. Welcome to my channel. In this video, I'm going to discuss about trading profit and loss account, which is otherwise known as income statement in some places. So under this topic, I will be looking at the meaning of trading account, what is profit and loss account is, what is the purpose of preparing trading profit and loss account, and also I will be looking at the basic terms used during the preparation of trading profit and loss account. Where finally I'm going to take a comprehensive question on trading profit and loss account, where I will be giving you a question and I will be preparing the trading account for the question. So let's get started. Trading profit and loss account, or income statement. So what is the objectives of preparing trading profit and loss account? Just like you know that the main objective of going to the business is to make profit. So any business, the reason why people go into business is to make profit. And this profit you are talking about, how do we determine the profit? So the profit of a business can be determined by matching the revenue against the expenses. So in a simple term, just like we know that if we are talking about profit, profit is sales minus cost. So in accounting, that sales is what I call revenue, while the cost is what I call expenses. So, and it's one of the accounting concepts which is called matching concept. The matching concept of accounting state that for a profit to be made, so that is, revenue has to be matched with the expenses before we can determine the profit of the business. So when revenue is greater than the expenses, so that is a profit. That is when your income, the amount you realize from sales, is more than the amount you used to buy the item. So that means you make a profit. But a situation whereby the revenue, that is less than the expenses, so that is loss. So when the amount you realize from selling items is less than the amount you used to buy the items, that means the business run into a loss. So trading profit and loss account is now prepared to determine whether a business make profit or loss. So that's the reason why I said it's prepared to determine the profit or loss of a business. So that's the purpose of preparing the trading profit and loss account. So now let's go into trading profit and loss account in proper. So trading account, this is prepared to determine the gross profit. If you are talking about gross profit, you are talking about profit made before the deduction of expenses. So gross profit is determined by subtracting cost of goods sold from net sales. That is, by subtracting the cost of the goods, the amount you use to purchase the goods, from the amount you realize from the sales of the goods. That's what this one is talking about. So if you are talking about cost of the goods, what are the cost of the goods? This include open stock, that is the amount of goods that are available in the business at the beginning of the period. Then add purchases, that is the total amount of goods you buy to join the one you are having in the business, and also the carriage inward, that is the cost of conveying those items you bought into the business. We call it carriage inward. When we add all these things together, then with less return outwards, that is all those goods that damaged in transit, so we have to return them back to the supplier. So the cost of those ones will be deducted from the addition of open stock purchases and carriage inward. Then we subtract the closing stock. When we subtract these two, we arrive at what we call cost of goods sold. So if you are talking about net sales, this can be calculated by subtracting return inward, that is sales return. Items you sell to customers, but they return it due to one reason or the other, which means you are going to deduct that amount from the amount of sales for you to actually get the actual sales. That actual sales is what you call net sales. Now, profit and loss account. If you are talking about profit and loss account, which is otherwise known as statement of profit or loss account and other comprehensive income or income statement, according to IFRS, it is called statement of profit and loss account and other comprehensive income, or just income statement. So these three terms still means the same thing. That is, we are still referring to the same account. So it reveals the financial position of an organization. That's the essence of preparing profit and loss account, to determine the financial position of an organization, to know whether the business make profit or loss. So it is prepared to determine the net profit of the business. So now let's look at the key terms when we are preparing trading profit and loss account. What are those key terms we are coming across? So the first one is open stock, purchases, carriage inward, return outwards. We have drawings, cost of goods available, cost of goods sold, net sales, gross profit, net profit, and expenses. Most of these items I've explained them under my account when I was discussing about manufacturing account, but I will still briefly explain each of them for better understanding. So let's start from the first item, which is opening stock. This is the amount of goods at the beginning of the year. That is when the business opened in the first day of the year. The total amount of goods that are available in the business is what we call opening stock. Now, purchases. So the total amount of goods being bought during the year. So that is what is regarded as purchases. That is, this is the amount of goods bought with an intention of being sold during the year. Take note of that word, intention of being sold during the year. That's what we call purchases. That is because at times the business will buy some items with the intention of being used. Those items are regarded as assets. So any items being bought with the intention of being sold, that means that is the usual dealing of the business. For example, a car dealer, when a car dealer is purchasing vehicles, those vehicles will be regarded as purchases in account. When a car dealer purchases table, which means office table, that table is an asset. It will not be regarded as purchases. That's what this definition is trying to clarify. That is, anything purchases with the intention of being sold, that is what we regarded as purchases. Carriage inward. These are the amount, that is the cost of conveying those goods being bought from the point of purchases to the business. That is what is regarded as carriage inward, which means all these costs will be added together. That is open stock, purchases, carriage inward. We add everything together when we are determining the cost of an item. So return outwards. So this refers to the amount of goods returned to the supplier due to some defects. So we buy the items, getting to the business, we realize that there are defects in some of the items. So the business will not take the responsibility. That means they have to return it back to the supplier. So all those items we return, we call them return outwards. So drawings. So what is drawing? This is used to describe goods or cash withdrawn for personal use. In account, there is difference between the owner and the business, because okay, this is my business, so I can just take anything. No, you can't take anything from the business because it is separated from the owner. So anything being taken from the business for personal use is regarded as drawing in account, and any withdrawal by the owner is seen as a reduction from his capital. That is it. So anything that the owner takes from the business, the amount will be deducted from the capital of the business. So at the same time, take for example, so such item will be deducted from purchases, and it will also reduce the capital of the owner of the business. So just like I said, this is because of what we call owners are separated from the business, which is called separate entity under accounting concept and convention. That is, there is difference between the owner and the business. So anything being taken by the owner will be regarded as drawing, and such item will be deducted from where it is taken, and at the same time deducted from the capital of the owner of the business. So cost of goods available. If we are talking about cost of goods available, we are talking about total amount of goods that are available in the business for the year, which comprises of open stock, purchases, carriage inward, less return outward. So this is the total amount of goods available for the year, just like I said. So it includes open stock, purchases, carriage inward, less return outward. So immediately we subtract return outwards, what you're having at that time is what you call cost of goods available for sales. So now, if you are now talking about cost of goods sold, this is arrived at by deducting closing stock from cost of goods available for sales. That is, when we have the cost of goods available for sales, at the end of the year, the amount of goods that remain in the store when the business is closing for the year, we call that closing stock. When we remove that closing stock from the total amount of goods that we have in the business for the year, so what we have at that time is what we call cost of goods sold. So net sales, like I explained earlier, this means the actual sales. It is realized by deducting all returns, that is sales return, something the business sold out but the customer returned to the business, so from sales. So what we have is what we call net sales, which is actual sales for the year. Now, gross profit. This is profit before deduction of expenses. That means the profit made before deduction of expenses. Just like I explained earlier, when we make sales, then the cost of purchasing the item, we remove it from sales. What we have is gross profit. So remember, there are some other expenses so that are to be deducted for, like salary of the workers, transportation. All those other expenses had not been deducted. So a profit made at that time is what we call gross profit. So it is the excess of net sales over cost of goods sold, just like I explained. So now net profit is the income after all the expenses have been deducted. That is, it is determined by deducting overhead expenses from gross profit. If you are talking about overhead expenses, you are talking about indirect expenses, just like I said earlier. What are the indirect expenses? So the indirect expenses, that is salary and wages, all those expenses being made, so immediately is deducted from gross profit. What we have left is net profit. But a situation when the expenses exceed the gross profit, that is, expenses is more than the gross profit we are having, that means the business is going to run into loss. So what we have at that time is what we call net loss. So you should take note of them. The expenses, if you are talking about expenses, according to the IFRS, expenses can be described as a gross outflow from the business and allocation of cost of assets, so which result to a decrease in economic benefit. This is the standard definition of expenses, and I'm going to explain what this means. If you're talking about gross outflow, it means anything that leads to reduction in the asset in form of cash. That is, we make payment, we buy anything we buy that leads to reduction of cash or reduction in value of asset, which is in form of depreciation. So when we are talking about tangible asset, that's depreciation. If you are talking about intangible asset, that is the amortization. If you are now talking about wasting asset, we'll be talking about depletion. So all those are regarded as expenses. And if we look at them, they brings about decrease in economic benefit. That is, as the expenses increases, the profit of the business will be reduces. But if these expenses are reducing, which means the profit will be increasing. So if you are talking about economic benefit, we are talking about the profit that will be derived later on by the business. So these expenses we are talking about can be categorized into three. That's the reason why I said the types of expenses, which include administrative expenses, selling and distribution expenses, and finance cost. All the expenses of the business can be categorized under these three. It's either they come under administrative expenses, or selling and distribution expenses, or finance cost. So what is administrative expenses? These are office expenses incurred for smooth running of the business. So any expenses within the office, for example, office rent is an administrative expenses. Salaries of the workers in the office is an administrative expenses. Payment of the electricity, among others. All these things are called administrative expenses. But if we are talking about selling and distribution expenses, we are talking about all those expenses that expenses that increase volume of sales. That is, when we make those expenses just to increase sales, and we know when sales increases, that means the economic benefit, that is the profit margin, will also increases. For example, carriage outward. When we take goods to the customer, this increase the number of the goods the customer will be buying. We also attract more customers. So advertising, all these expenses are selling and distribution expenses, commission given to agents or customers, or to encourage customers to buy in large. So wages of sales representatives, all these are called selling and distribution expenses. If we are not talking about finance costs, we are talking about all those costs of servicing debts, just like loan, overdraft. We know business will be paying interest on loan. All those interests are called finance cost. Just like I said, for example, interest on loan, lease expenses, among others. So these are examples of financed cost. Now let's take an illustration under trading profit and loss account. The trial balance extracted from the book of Fadwood Enterprises as 31st December 2022 is as follow. We have sales 250,000 naira, purchases 120,000 naira, carriage inward 5,000 naira, carriage outward 2,500 naira, stock as at 1st of January 2022 21,000 naira. We have sales return 4,000 naira, drawings 15,000 naira, discount received 4,500 naira, return outward 5,500 naira, discount allowed 3,500, rent 5,000 naira, wages 12,000 naira, advertising 3,500, depreciation of plant and machinery 6,000 naira, bad debt 2,000 naira, stock of goods at 31st December 2022 at 12,500 naira. You are required to prepare trading profit and loss account of Fadwood Enterprises for the year ended 31st December 2022. Now, solution: Fadwood Enterprises. So the title, trading profit and loss account. And remember, the next thing is to put is the unit of measurement, which is naira. So for those who are using this format, and we can also use T format, or those who only know how to use T format in preparing trading profit and loss account. So we have our T format, Fadwood Enterprises. So the title, trading profit and loss account for the year ended 31st December 2022. Now we put our naira sign, which is the unit of measurement. Now let's go to the question. So remember, like I said, when we are talking about trading account, I say it's prepared to determine what? Gross profit. And the gross profit of the business is determined by subtracting cost of goods sold from net sales, which means we need to ascertain the value of net sales, and we need to ascertain the value of cost of goods. So just like I explained earlier, I said net sales means sales less return inward. Why? Cost of goods sold, as we have it here, include open stock, purchases, and carriage inward, less return outward and closing stock. Now, net sales, just like I said, include sales less return inward. So to those who are using this format, net sales will be the first thing you calculate, that is sales less return inward. Let's go to the question and look at the value of sales. We have sales 250,000 naira, then sales value 250,000 naira. Like I said, let's return inward. Let's go. So if you are using the T format, sales will be at the anything revenue will be at the credit side, anything expenses will be at the debit side. So let's go to our T account, which means sales will be at the credit side. Sales 250,000 naira. Back to the question. We have sales return, which is return inward, 4,000 naira. We are going to remove return inward from sales to have our net sales. So back to our account, let's return inward, 4,000 naira. 250,000 naira minus 4,000 naira, that is going to give us 246,000 naira. That is our net sales. So if you are using T account, so which means we have our what? Let's return inward, which is 4,000 naira. If we subtract 4,000 naira from 250,000 naira, we have 246,000 naira. So we have our net sales now. Then the next thing is what? Our cost of goods sold, which I said it comprises of what? Open stock, purchases, carriage inward. Our open stock, we have stock at 1st of January 01/01/2022, which is 21,000. That is our open stock. So we have open stock 21,000 naira. But if we are using the T format, just like I said, anything expenses will be at what? At the debit side. So which means our open stock will be at the debit side as open stock 12,000 naira. Now back to the question. Purchases 120,000 naira. If you are using this format, then add purchases, open stock plus purchases. If you remember, purchases to 120,000 naira. If we are using the T format, our purchases will come next. Purchases 120,000 naira. Then next item is carriage inward. Let's check the question if we have carriage inward. Yes, there is carriage inward, which is 5,000 naira. So we are going to add carriage inward. So carriage inward 5,000 naira. If we had 21,000 naira, 120,000 naira, and 5,000 naira, that is going to give us 146,000 naira. In our T format, the same thing happens. Add carriage inward, which is 5,000 naira. If we add everything together, 146,000 naira. If you remember, open stock, purchases, carriage inward, less return outward. Let's check the question. Do we have anything on return outward? No, okay, we have drawings. Just like I said, anything withdrawn by the owner for personal use will be deducted from the item. So drawing also, we are going to remove drawing before we deduct return outward. So our drawing is 15,000 naira. So less drawing 15,000 naira. If we subtract 15,000 naira from 146,000 naira, that is going to give us 131,000 naira, because we want to determine the actual amount of goods that are available in the business. That's what we are trying to do. So to our T format, the same thing happens. Less return drawing, which is 15,000 naira. If we subtract 15,000 naira, that will be 131,000 naira. Now let's go and check the question. If we have return outward, that is all those goods that are returned back to the supplier. So we have return outward, which is 5,500 naira. So we are going to subtract that as well. Less return outward, which is 5,000 naira. 131,000 minus 5,000 naira, that is 126,000 naira. And this 126,000 naira actually gives us the total amount of goods that are available for the year. So cost of goods available, that is our cost of goods available. So the same thing to our T format, less return outward, which is 5,000 naira. If we subtract 5,000 naira, that is going to give us 126,000 naira, which is our cost of goods available for sales. If you remember, so we said to arrive at our cost of goods, so we now subtract closing stock. So let's go and look for the value of the closing stock. Closing stock don't used to be in the trial balance. It used to come under additional information. Take note of that. So if you look at it under the last paragraph, we have stock of goods at 31st December 2022 at 12,500. So we are going to subtract closing stock from it. That is less closing stock, 12,500. If we subtract that, it's going to give us 113,500. That is our cost of goods sold. So we call that's our cost of goods sold. So if we are using our T format, the same thing happens. Less closing stock. So our closing stock 12,500. Remember, in account, when we are subtracting, we put the value in brackets. That's what we know. That's what we use to identify the number to add and the one to subtract. So any number in bracket means we are going to subtract it from the rest. So 126,000 minus 12,500, that is going to give us 113,500. Just like I said, that is our cost of goods sold. And if you remember, we said, how do we determine gross profit? Gross profit means what? Net sales minus cost of goods sold. So we have our net sales and we have our cost of goods. So let's close the account, close the two accounts. If we look at the two value, 113,000, 246,000. So our net sales is higher than the cost of goods sold. So that amount will be written at the total side of the two. If you compare, just like I said, that's 246,000, 246,000, 113,500. If you now subtract it, that is our cost of goods sold, which is 113,500. If we subtract it from 246,000, that is going to give us 132,000 naira 500. So that balance is what we call the gross profit. That is the gross profit of the business for the year. So to those of you using this format, we already have our cost of goods sold. Let's close the account, take it to under the total column where we have our net sales, which is 246,000. If we subtract 113,500 from 246,000, that is going to give us 132,500, and that is our gross profit for the year. So remember, that's not where we are going. Is the net profit we want to determine. That means we are still going to add every other income to the gross profit and subtract all the expenses from it before we can arrive at our net profit. Now let's go to the question. So we have discount received. So discount received, just like I said, any other income will be added to the gross profit. Discount received means discount that the business received from their supplier, which is 4,500. It's an income that will be added to the gross profit. So our gross profit, so let's continue the next page. We have our gross profit 132,500. So discount received 4,500. We are going to add that to it. So back to our T format, the same thing happened. We have our gross profit, remember. So at that side, that will be gross profit carried down. We now bring the gross profit down to the credit side of the account as gross profit brought down, which is 132,500. Then we had discount received, which will be credited to trading profit and loss account. That is discount received 4,500. Now let's look at the expenses. We have carriage outward, the amount used to transport goods to the customer, which is 2,500, is an expenses. So all the expenses, let's add all the expenses together before. So we have expenses carriage outward, which is 2,500. Under our T format, remember, anything expenses will be at the debit side. So our carriage outward will be at the debit side, which is 2,500. Let's look at the other expenses. We have discount allowed. Discount that the business allowed to the customer, which is 3,500. So continue under our expenses. We have discount allowed 3,500. In our T format, we debit that to the trading profit and loss account. Discount allowed 3,500. So we have rent 5,000. It's also an expenses. Under our expenses, we have rent 5,000 naira. In our T format, the same thing happens. Expenses, we have rent 5,000 naira. Next expenses, you have wages 12,000 naira. So under expenses, we had wages 12,000 naira. To those who are using the T format, the same thing happened. We debit that to the account, which is wages 12,000 naira. We have advertising, which is 3,500. In our profit and loss account, we had advertising 3,500. To those who are using the T format, we also have our advertising at the debit side 3,500. Next expenses, we have depreciation on plant and machinery, which is 6,000. It's an expenses which is as a result of wear and tear and the value of the asset. So the value of the asset will be written off over the years. The asset will be used. So for that current year, 6,000 is charged. So it's an expenses to the business that will be added to other expenses. We have depreciation on plant and machinery 6,000. In our T account, depreciation on plant and machinery 6,000 naira. So we have bad debt, which is 2,000 naira. It's also an expenses. So bad debt 2,000 naira. In our T account, bad debt 2,000 naira. So back to the question, if you look at it, we don't have any other expenses again. So we've treated all the items we have in the account. So let's go back to our account. So in that place, let's close the account. What is the total of the expenses? So if we had everything together, 2,500, 3,500, 5,000, 12,000, 3,500, 6,000, and 2,000 for the bad debt. If we had everything together, that is going to give us 34,500, which means we are going to subtract that value from the gross profit and discount received. That is, we had gross profit plus discount received, which is going to give us 137,000. If we subtract that, the balance will be 102,500. So that amount is what we now call our net profit. That is our net profit. That is after we deduct all the expenses from gross profit and other income. So the balance we are having is what we call the net profit. So to those of you using the T account, so we close the account. After we close the account, if we look at the value, we had all the expenses together. That is 2,500, 3,500, 5,000, 12,000, 35, 6,000, and 2,000 for bad debt. If we had everything together, that is going to give us 34,500. Let's look at our income, that is gross profit and discount received. If we had everything together, the value is 137,000 naira, which means amount of our income is more than the expenses. So which means the business make profit. So the one that is higher is what will be written at the total column. That means our total is going to be 137,000 naira at both sides. So remember, our expenses is 34,500. If we subtract 34,500 from 137,000 naira, it's going to give us 102,500. At the debit side, that's where we write it, and that is going to be our net profit. So that is just the simple way how to prepare trading profit and loss account, which is otherwise known as income statement. So for the other format, this is the full format. I'll combine the 2 pages or together to give you the full details of it. So that is all about preparation of trading profit and loss account. In my next video, I will be focusing on end of the year adjustment before we now come back and treat the full question that will involve end of the year adjustment under trading profit and loss account. To those who are looking for the advanced one, that is for income statement at the advanced level, that will be coming up later after I treated all the end of the year adjustment. So thank you very much for watching the video. Don't forget to subscribe to the channel